Good afternoon, fellow traders, to another webinar from the Blue Sky Forex webinar series. Today's topic is Fibonacci trading in FX. If you were on our last webinar last week, which was about support and resistance levels, then you do perhaps recall that I mentioned that Fibonacci retracements, which is one of the Fibonacci technical indicators, can also serve as really good support and resistance levels. And this is something we will also be viewing inside MetaTrader 4, how these Fibonacci retracement levels have served their purpose in the past and most likely will manipulate the price or affect the price movements in the future as well. Now, just while letting the few last people connect, let me just quickly go through the disclaimer. If somebody can't hear me or doesn't see the presentation, then feel free to let me know in the question section. So bear with me for a moment. Contents of this material are provided by third party, not hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, let's just take a quick look at our agenda today. I will quickly introduce myself. We'll then discuss or go through the two types of markets you will come across when carrying out your daily trading activities. We'll talk about what the Fibonacci theory is all about, and we will provide you with one really simplistic and straightforward strategy you can use with Fibonacci retracement. And of course, we'll discuss the stop loss and take profit management as well. And of course, at the very end, you can ask all your questions. So please do write them down during the webinar. And at the right time, you can just go ahead and write them in the question section. Right, so I'm one of the senior traders here in Blue Sky Forex. We are an education, research, and trading group. We do provide 24-hour trade support and analysis just to help all FX retail traders to make better and safer trading decisions, okay? We do have our own trading styles, all of us. We teach different various strategies, and we do approach the markets differently as well, somewhat. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex to educate you and help you become highly profitable currency traders. So let's take a look at two types of markets you will come across. First of all is price action, aka a trending market. This is more powerful, and the reason behind this is that the proper trending market where you see a significant price movement and you can potentially profit from it. These type of movements, they need to be fueled by significant news on the market. Okay, so when you have some significant news moving the price in this certain direction, and you identify the news being with high impact onto the underlying asset, and you also visually analyze the price action that it indeed is moving in a certain direction really forcefully, then of course you can jump in the trade and benefit from the big move. Okay, it is a bit more difficult to identify than a mean reversion market, and the reason behind this is that you will need to have some ability to fundamentally analyze what is going on in the economy and in the industry. You need to be able to realize what news are affecting certain assets significantly, what news, what events can make the prices move. So this fundamental knowledge is required to properly benefit from a trending market. Okay, but trend is your friend, as people say, and I feel that this is definitely true. So yeah, something to keep in mind. The other market type is mean reversion, aka a ranging market. It is more common. It is easier to identify because the price is essentially then bouncing between the nearest support and resistance level. Ranging markets can be profitable, and again, they are easier to identify. Now, in terms of Fibonacci retracement patterns, the focus will be on somewhat trending markets, how to use these Fibonacci patterns on a trending market. This is the solution or the approach for Fibonacci retracement trading will be provided on a trending market. However, this tool can successfully be used in a ranging market as well. Okay. So, what is Fibonacci theory? So Fibonacci theory, it's really simple, right? Every next number is the sum of two previous numbers. Okay, so just to simplify it, let you see the sequence here on the left side as well. So let me just explain. 1 plus 0, let's pretend 0 is here. 1 plus 0 is 1. Then 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5, etc. So it's extremely simple. It's really straightforward. So this is the Fibonacci sequence. Each new number or each current number is the sum of two previous numbers. And this sequence was discovered by Italian mathematician Leonardo Fibonacci already on the 13th century. However, the roots of this sequence and this ideology do go back to already Indian mathematics. Leonardo Fibonacci was just the one who introduced this idea and discovery to the Western mathematics. Okay. So the interesting thing about this Fibonacci sequence is that you can find this all around you. You know, also in nature and in yourself. You can find it in bee procreation patterns, flower patterns, and of course other biological systems as well. So it is somewhat mysterious and at the same time really fascinating. And as we humans, we are part of nature, then this Fibonacci sequence is also carried into the market, into the industry, because our trading decision making is somewhat affected by this Fibonacci sequence too. Okay. So there are different Fibonacci indicators out there, which is Fibonacci arcs, fans, time zones. But what we are focusing on this webinar are the Fibonacci retracements. Okay, this is an technical indicator. It is definitely available by default in MetaTrader 4. MetaTrader 4, you know, is usually provided by all different brokers, most commonly. If you're using any other platform for trading, then I'm quite sure Fibonacci retracement tool is available there. If not, then I'm extremely sure that it is provided as a custom downloadable indicator onto the platform, because Fibonacci retracements is a very commonly used tool when making the trading decisions, and extremely useful one as well. Okay, and I will show you why and how, as these Fibonacci retracement levels, as already mentioned earlier, they do serve as really good support and resistance levels. Okay. So the levels that you can see in the Fibonacci retracement tool by default usually is the 23.6, 38.2, 50, 61.8, and 100% retracement levels. Okay, and these are also the ones drawn on by default, I think, in a MetaTrader 4 Fibonacci retracement tool as well. So let's first of all take a look at the conditions that you should look out for when trading this basic and easy to approach Fibonacci retracement method. Okay, so the first of all, I will also show this on the chart on the next slide, but first of all, just a theory. If there has been a large drop in the price during the main trading day, during the London session, London US overlap, and in the early US session, and there hasn't, and there has actually been a significant news that has caused this drop to happen, and preferably in the range of 4 hours during the trading session. You should wait until it is after 5 p.m. GMT, so to make sure that the London market has already closed. This is just for the added upside pressure for the retracement. Then you will do, the drop has to be more than 100 pips, okay? That is definitely something to keep in mind. More than 100 pips drop during the day, during the London session. Make sure it's past the London session after 5 p.m. GMT. You will then take the Fibonacci retracement tool or indicator on your platform. You will draw the line starting from the very peak before the drop to the very low point after the drop. Okay. You can identify a possible exhaustion or indecision setting in with maybe 1 or 2 green candles after the significant consecutive price drop within those maybe up to 4 hours. And this price action, it will create a good price retracement opportunity. And when you draw the Fibonacci retracement tool, you will then see these different percentage levels on your chart. Okay, and these are the levels where the price will possibly retrace to. It's really easy to understand if you see it in the chart in a moment, but just the theory, you would then, if after you see maybe 1 or 2 green candles, okay, the exhaustion setting in, then you will open a call position and aiming for the retracement to the very first retracement level at 23.6%. Okay, and this of course assuming that the price is still a healthy distance away from the very first retracement level. And these steps can also be applied to when looking out for short opportunities when the price is moving upwards. Okay, so let's take a look of what I was just talking about. So we have here a significant drop in the price throughout the London session. Now, one thing to note here that I personally would prefer the drop to happen throughout 4 hours in time. This is, of course, already a 9-hour or an 8-hour drop. But the quicker the drop happens during the London session, the better the retracement opportunity, because you see here on this chart, as the retracement was a bit slower than I would prefer, you would have the exhaustion setting in, but quite in a large magnitude, as the wicks are relatively large and do already reach the very first retracement level here. Okay, so if the drop was a bit quicker, then you would most likely have the exhaustion candles a bit smaller, and you would see a clearer and better call or a long opportunity to trade towards the very first retracement level. But just putting that aside for a moment, let's look at this example here. The price has dropped throughout the London session significantly, and at the moment here at this point you already see the exhaustion setting in. The very first, the last red candle here and under my cursor before the green one already has quite large wicks, right? Larger than the candle itself. And then we already have a doji setting in. We have a really, really large wicks that actually do reach the very first retracement line. So at this point, after this green candle closes here, you should look for going long and trading towards the very first retracement level. Okay, and trading from here to here, you would have earned, some pips definitely. Can't really say what is the proper distance. It is a 1 hour chart, AUD, JPY. It's fine. You would still have earned some profit. Okay. If you prefer a bit riskier trades, then you can also set your take profit to the next retracement level if you feel that at the very first retracement level, is not really going to hold off the price, and there will be a bigger retracement taking place. So in this scenario, you will be able to earn a bit more profit when setting the take profit to the next retracement level. You see 0.618 here, etc., but this just represents the actual percentage levels. This is 61.8%, this is 50%, and then so on. Okay, so you wouldn't really get confused. So you draw the Fibonacci line from the high before the drop to the very bottom line of the drop. Okay, so on to this really wick. So this is where you draw the Fibonacci retracement line. Okay, then you get these levels, and if the price is already having or seeing some exhaustion setting in, you can trade towards the very first retracement line. You can trade in the other direction as well after the price has reached the first retracement line, and you are confident that the price will continue in the direction of the trend if the news has been extremely significant and extremely strong, and you feel the price will continue in the direction of the trend, and this has just been a brief exhaustion, brief correction of the price. Perhaps some buy orders were absorbed here at this moment, and you still feel that the price will continue in the same direction, then what you can do is just initiate a short order just above, a bit above the very first retracement line. Okay, so this is another trading opportunity that you can practice, although I would say that this is a bit more risky. Okay, because in some cases the prices, they can even experience 50% retracement, 50% correction, and in this scenario you would really easily hit your stop loss if you already went short at this point. Okay, a bit safer entry in this scenario when going short on this after this heavy price drop would be on the second retracement level at 38.2%. Okay, this would be a bit safer entry, but still I would say that the very safest way to trade this would be by going long towards the actual retracement levels, just trading with the correction or trading with the corrective wave. Okay, so quite a simplistic approach indeed, but really efficient if you notice a price action meeting those conditions that we discussed earlier. So during the London session, a significant price drop, and I would say no more than 4 hours in total. So 4 big candles resulting in a drop of more than 100 pips. After you see an exhaustion within maybe 2 candles, and it is still appropriate distance away from the first retracement level, then trade towards the retracement. Okay, really easy and straightforward. If you have a large risk appetite, set the stop loss to the second retracement level. If your trade entry would be somewhere around here, then it's good to set your stop loss to the 0 point or the Fibonacci line, just at the very end point, or just a bit below it. Okay, to give it a bit of headroom for movement. All right, so this is a really easy and simple way how to do it. Let me just quickly go into 1 second. Let me go into a MetaTrader 4. Let me open it up. I was a bit in a hurry, so I didn't get to open it up before the webinar. Just give me a second. Okay, you should be seeing the chart now. Okay. Right, so let's take a look here. This is a Euro USD 1 hour chart. And in a bigger way, in a bigger perspective, how you can apply the Fibonacci retracement tool is just to look for these bigger support and resistance levels. Okay. So where you can find the Fibonacci retracement tool inside MetaTrader 4, if you have this toolbar already open, then the Fibonacci retracement tool is marked with an F in the bottom right corner and these 4 horizontal dotty lines. Okay, so this is what the low button looks like. Here you can find the Fibonacci retracement. Okay. Another place where you can find it is when you go to Insert, you find the Fibonacci category, and here you can also find the retracements at the very top. Okay. So on this occasion, let's just take a look at how we can utilize this Fibonacci retracement tool. Okay, we're analyzing a price right now from the 6th of August up till the 5th or 16th of August. What I see here that, the bigger drop, of course, happened already on the very 31st of July, but there was, to my visual analysis at least, a significant correction, already a 50% correction here. So I would consider drawing the Fibonacci retracement tool from this point here, if you see it. Okay. So you start drawing it from here and you draw it to the very bottom of the lowest low. All right. So let's say you are analyzing the price. It has dropped this low. You see it going up a bit, and you are at this point already. Please note that this is not the example of the strategy that I showed on the previous slides. Okay, this is just a general purpose usage scenario where how you can find support resistance levels that potentially will play a role in the future price movements. Okay, just keep that in mind. This is not an example of a strategy that I showed earlier. Now, coming back to the charts, you are here at this point. The price is already going up a bit. You see it has reached the very first retracement level. Okay, so we consider this retracement level as valid. You see 23.6%, 38.2, 50, 61, and 100 retracement. Okay, so let's analyze if the price actually, or if those levels have affected the price movements in the past, right? So already at this point, sorry, my screen is flickering a bit. Not sure what happened there. Give me a moment. Weird. Okay, got it now. Okay, back to the charts. As you can see, the very first retracement level, as soon as the price reaches this level, you see some indecision setting in, right? So you see, bearish candles, again, bullish candles, some more wicks than before. You see a lot of exhaustion, indecision going around on the very first level. The second level, uh, sure, you have quite a significant candle moving upwards, piercing the level, but after this hour ends, the price starts dropping, is bearish. Nothing major happened on this level at this point, so as well as on the 50% retracement. On the 61% level, you do see that after the large candle pierced it, maybe there was some economic event or news hitting the market, we don't know. But after this candle pierced that level, you see some indecision, okay? So at the very 100% retracement, again, you see some indecision. Okay, that is that. Nothing really major happened on these levels with this example. Let's raise it to this point and see what these levels now show us. Okay, so this all depends on how you draw it and what points you take as your starting and your ending point. Okay, so the very first retracement level, on this occasion you see the price bouncing right off from this retracement. Some indecision at this point. When it came back down to the first retracement level, bounces right back off and goes upwards. So you see, when we change the starting point of the Fibonacci retracement tool, the lines changed a bit, and the lines did become more effective in future price movements, right? You see really heavy indecision at this level here. Again, this point serves quite a good support resistance level, right? So it's just a small change, and the levels changed as well, and these levels became more effective in the future price moments. Let's just go further into the past a bit. We have quite a ranging market. Okay, this is also a good example actually. Let's take a look at a ranging market. Okay, we have this. It's a relatively large magnitude range, but it's still a range. We can do it even from, let me just zoom out a bit. Okay. So the price moved, okay, we had a significant trend going down. Then we have a price was supported here, bounced back up, and the range settled in. Okay, so let's say you're analyzing the price in the beginning of July. You are here at this moment in time. So in this scenario, as you have analyzed that you have a range setting in here already, you can draw the Fibonacci retracement tool from this point here to this point here. Okay? Does this make sense? Why you're drawing the lines from here to here? Because in a range, this is the lowest point, and this is the highest point in the range, right? Okay. And you need to start drawing it from the start to the highest point in the middle of the range. Anyways, let's now analyze the price movements after you have drawn this Fibonacci retracement tool. Okay. We discussed that we are analyzing the price already in the beginning of July, because then we have determined that we have this range setting in. Okay, you see how significant the first level of the retracement already plays a role in future price movements. Let me just move in a bit so you can see better. So this is the first retracement level. Let's just take a look here. We see how this level is repelling the price in this occasion from moving upwards. The price is generating a smaller range between this first and the second retracement level. You see the price going up and down on several occasions between those two levels. Same here. You see the price just moving up and down between those two levels here. In several occasions, price is just bouncing off this level, right? So you see how strong these levels are in terms of support and resistance, and the price does abide the rules of support and resistance really, really well. Okay, so the third retracement level, price is exactly bouncing off as soon as it reaches here. On this occasion, here as well, you have again indecision setting in. So many cases, the third retracement level is just bouncing the price off really, really sharply. The same goes for the really second retracement level. Okay. And again, just looking further a bit into the past, after we have dealt with this, heavily long-lasting, bigger range of the price, let's say we left these retracement levels onto the chart, and after 1.5 months or after 2 months, the price goes back to these levels. We can analyze that the same levels we had used before, they are playing a role in the price movement right now as well, right? You see the third retracement level from the bottom. It is already, acting as a resistance at this point. Again, you see indecision setting in at this level here, right? When the price went from below, it reached this level, it bounced right back off once again until it pierced it, right? So you see the power of the Fibonacci retracement and those levels and what role they play in the future price movements and how well they serve as support resistance levels, right? So it's really, really easy to see. You can take any point on the chart and draw the Fibonacci retracement. You will have to, of course, draw it correctly, because if you draw the Fibonacci retracement, just randomly from here to here, these levels are not valid. You can't really use it. You have to draw it from the very highest high to the lowest low, and vice versa. In a ranging market, you have to draw it from the very low point of the established range to the very high point of the established range. Okay, preferably from the left to the right for the easiest analysis, right? So you could also draw the Fibonacci retracement from here to here, for example. Oh, is that the range we analyzed already? Okay, no, it isn't. It's another range. So again, in a ranging market, you see how this, and this level, even this one, played a really, really important role of the future price movement on this occasion, etc. Right? You get the point. So take up a chart, just start playing around with the Fibonacci retracement tool. I'm really sure you will find patterns that are really easy to identify, that you find really easy to use, and how well these levels and these lines actually take effect in the future price movements. Okay. So I think we are done with the material. Just provide me with one moment. Okay, yes, we are done. There are no further slides. If I will take questions now, but if you have any questions that remain unattended or unanswered for any technical reasons, then please do send an email to webinars@hotforex.com, and they will do their best to answer to your questions as well. Okay, so let me just open up the question section and start getting them from top to bottom. One moment. I hope I pronounced your question, your name correctly. Sabia Shahi, Sachi, if he asked that which level is the safest and most frequently touched while retracing? Okay, what I can say from my own experience and visual analysis, the first line, I mean, that is touched most frequently, obviously, because as soon as it goes ahead and touches the next level, the very first level has already been reached, right? But I think what you are meaning is what is the very furthest point of the retracement that usually happens. I think that is the meaning of your question. And what I can say from my own personal experience that the second retracement level is somewhat, I have found it somewhat most useful in order to trade with the simplistic and basic approach that I also showed on the charts for going short on the example when the price had dropped significantly. Okay, when the price is already reaching the third level of the retracement, then the possibility of a bigger price reversal in place is a lot higher when it retraces just the very first or the second level. The higher it goes, then, you know, as per logic, the higher the chances of the full retracement happening. Okay. So if you go short at the second retracement level and trade towards the first retracement level, because that is where your take profit should be if you're going short at the second retracement level. In this scenario, you know, if it doesn't go in your way and if it reaches already the third retracement level, then you would just need to accept the loss and look for other trading opportunities, right? Because no matter the strategy, no matter what approach you use towards trading, there is no 100% accurate trading strategy, and it all depends on the market conditions. Okay. If you trade at the very first retracement level already and go short, that is also fine. This is the very core of this simplistic approach you can use anyways. If you want, you can try trading short at the second retracement level. Okay. The simplistic approach, of course, is trading the retracement itself, right? So you will trade before the retracement has reached the very first level already. So setting your take profit to the first retracement level would be sufficient. If you're more risk appetite, then you can trade or set your take profit at the very second retracement level. And he's also asking, what if the candle has already retraced and closed above the first retracement level, which is at 23.6%? Should we then go long? I would not, because if the price has already retraced that level, I would only look for short opportunities in this scenario. Okay, because going long at that level where it already might bounce back and continue the trend from, you have already lost out some significant profit. So no point to initiate a too risky trades in this case. Okay, Abhishek is asking just for a confluence between two intervals, like 15 or 60 minutes. This analysis is something you can do on your side personally. But what I can say on a larger scale is that you can use the Fibonacci retracement tool no matter the chart time frame. If you draw it on a 4-hour chart, then these retracement levels will still be highly efficient um, in serving to affect the price movements in the future. That is totally fine. Same way goes for 15-minute charts. Okay. And if you draw the Fibonacci retracement tool on a 4-hour chart, and then you switch to a 15-minute chart, these levels will still be in effect, of course, but they won't be so accurate because you will see a lot of the times the price just piercing those levels, but in a larger scale they will still be in effect. Okay. Okay, Dennis is asking, what do these really small candles usually mean in the charts? Okay, the actual size of the candles don't tell the whole story. You can have an extremely small candle but a lot of volume behind it, and you can have an extremely large candle with a lot less volume behind it. So for example, if you see a very small candle with a relatively sized, decently sized wicks, if there is a high volume behind it, that means that there has been a really heavy, so to say, war between the bulls and bears, and it's a really, voluminous market. And there might have been some really confusing news that were released that triggered some bulls to make a lot of trades and triggered some bears to make a lot of trades, right? At the same time, if you have a really small candle but there is no volume behind it, that means you're just dealing with a really calm market, and not many orders were initiated on that asset. So the size of candles, it can mean then two things, and just like I explained at the moment. At the same time, if you have a really large candle and not a big volume behind it, that means that there was maybe some event happening on the market that triggered part of the bulls making their orders, but didn't trigger anybody else, right? So the majority are still passive, and only some of the big traders initiated their orders. So it doesn't only boil down to the really size of the candle. Okay, Sabyasachi is asking, in a sideways market, should we draw the new Fibonacci line based on the recent lows and highs, or should we only refer to the highest and lowest point? You should refer to the highest and lowest point within that ranging period. So first of all, you have to determine the very start point of the range, and then you will start drawing from the very low point to the highest point within that period, from the current to the start, current point in time to the very start of the range. Okay, Muzi is asking quite a good question. When my Fibonacci retracement has reached 100%, so 100% retracement from the actual move, is it safe to enter a buy trade when other signals are showing a strong buy opportunity, or should I wait for a pullback first? It is a good question, but on this occasion I will have to answer that there is really no definitive answer to that. It does completely depend on the market conditions. It does depend on what is really signaling you about a bullish market and a bullish or long trade opportunity. You would need to analyze the previous price history for any significant support resistance levels, because if the 100% retracement level is lying on a significant resistance point, then I would certainly wait for some degree pullback before even looking at a long opportunity. If the price has significantly pierced the 100% retracement level in 1 hour, an example, then I would say it is a bit safer to go long and trade with the significant move, because something might have happened on the fundamental side of the market that is driving the price upwards still. Okay, so again, it all depends on the market conditions. You would have to analyze the fundamental part as well to see, what might be moving the price upwards still, even after the 100% retracement. Okay. Samuel, we always have the webinars recorded, and these will be uploaded onto the past webinar section on the Hot Forex webinar page. If you log in, if you go to, I think it was education at the bottom, there you will find the recordings of the webinars, and you will have a selection there, past webinars. Then you can see, then you will see the recorded webinars that are uploaded there. Sabasahi is asking, what risk-reward ratio would you recommend? Sometimes 1 to 2 is too much based on pips. Okay, what I personally recommend starters or beginners to use is a risk-reward ratio to about 1 to 1. Okay, this is a good starting point. And moving, if you get a bit better, then moving to 1 to 2 is a complete, it's a right step. And 1 to 2 is actually really, really good. It's a really, really good risk-reward ratio, which I quite often apply, to be honest. If I'm somewhat not overly confident about a certain trade that I make, then I will use 1 to 2. Okay. If I'm very confident about a certain trade that I'm going to make, fundamentally and technically, then my risk-reward ratio can also reach 1 to 3. Okay. The very most professional traders and expert traders, they can go up to 1 to 4 and 1 to 5, but anywhere from 1 to 5, it's already a bit too much, right? Because then you will not reach your take profit level most likely, and you will hit your stop loss instead because the price reverses before you get there. Okay, but for beginners, 1 to 1 is perfectly fine. And when you get a bit better, if you get used to the market, then 1 to 2, it is great, because it also depends. If you're talking about pips here, Okay, and then it depends on what type of trader you are. If you are a scalper, then you will be most likely aiming for these 25, 30, 40 pip trades. In this case, 1 to 2 is definitely something you should really consider. Okay, 1 to 1, you're setting the stop loss quite far away, and you're giving the price a bit too much room for playing. So if you're scalping, 1 to 2 is more than great. If you are, let's say, a position trader and are aiming for these extreme large movements, right? Maybe you want to earn like 2,000 pips for a trade. Then applying 1 to 2 is a bit extreme pip wise as well. Yes, I agree to that completely. So yeah, depends on what type of trader you are as well. Just take that into consideration. I hope I somewhat addressed your question. Okay, I have a question about are there any indicators that go well with Fibonacci retracement tool? Essentially, you could potentially use any overbought, oversold indicators just to pinpoint the reversal of the price, maybe RSI, stochastics. If you are using the Fibonacci retracement in a way that you have a large drop, the price is now retracing, it has reached the first or the second level of retracement, and now you're finding a short opportunity just to trade along with the bigger price movement if you're convinced that the price will still continue in the direction of the trend. Then you can use the overbought, oversold indicators just to pinpoint when the price is reaching that overbought area again, when it has reached the first or second retracement level, and then just go short, right? So, applying these overbought, oversold indicators, you can incorporate those, but I would say that Fibonacci retracement tool alone is already a relatively powerful tool that you don't really need to apply any analysis or any data from any other indicators to make your trading decisions. Okay, Pech Kok Cheng is asking, would changing the margin requirement result you to change your Fibonacci level to accommodate the risk increase? No, I would not change the Fibonacci retracement levels. The levels that are by default marked into the Fibonacci retracement tool, these are the levels that are defined in the Fibonacci theory, and these levels should be used. There are a few more levels that are not by default drawn onto the scale of the Fibonacci retracements. So the very core ones that I showed, you should use these ones. Okay, Marco is saying Fibonacci cannot be drawn from any impulse. Should it necessarily be done in a market recession that has tendency? Is this right? And I would say that the Fibonacci retracement tool, it can be used in any market condition. Okay, so that would be my straightforward answer to that. Akin Kumi is saying you can't see the live video. Most likely you're talking about the presentation and then the screen then in this case. I do apologize if there was some technical errors, but most of the attendees, they didn't have any issues with the visuals. What you could do, you could then check the webinar recording if you find it on the website later on after logging into your Hot Forex account. Okay, we are approaching the 1 hour mark, and as I haven't seen any further questions for some time, then thank you very much for attending today's webinar. It was a pleasure to seeing so many of you here, and we will meet again next month. I don't know by heart what is the next topic, but anyways, you'll find it in the schedule. So stay tuned, trade safe, and enjoy the rest of your day. Take care, everybody.